Few things can get the average investor's attention as well as a good old-fashioned, juicy, high-yielding stock or fund. Yeah, baby. In fact, I could start you out at a theoretical 10%, and for every 1% increase, get more and more curious onlookers to join us. 11%? Made you look. 12%? Made you look. 20%? Okay, enough with the nonsense. Today's ETF contest is an audience-requested matchup between two juicy yielding ETFs. Which funds are they and what are their ticker symbols? Made you look. Stick around for the answer. A cordial welcome to all. You're watching ETF Battles. I'm DeLegge. And if you're new to the show, welcome aboard. Be sure to hit that subscribe button and join our community. We're almost at 50,000. And if you like the show, well, tell us by hitting that like button. If there's an ETF battle that you'd like to see, send me your ETF ticker symbols in the comments section below or on our X feed at ETF Guide. Also, don't forget to visit the description section below. I've got links to our program judges. I've also got links to our program sponsor, Direction, along with links to viewer resources, including free audio and ebooks and other goodies. So be sure to check that out. Today's ETF bout was requested by a viewer named Eric LVV777, and it is a ETF contest between funds from the same ETF family. We've got the NEOS NASDAQ 100 High Income ETF, QQQI, going up against the NEOS S&P 500 High Income ETF, that's SPYI. And rather than getting income from dividends, both funds get what's called synthetic income from specialized option strategies, which our judges will no doubt elaborate upon. So without further ado, let's welcome them. We've got Shana Sissel with Banríon Capital and Mike Akins with ETF Action. Judges, welcome back to ETF Battles.
Great to be here, Ron.
It's great to be here. Good to see you.
So our four battle categories are cost, exposure strategy, performance and yield are combined, and then we've got our mystery category where the judges can pick a certain factor or thing that they feel is crucial to today's contest. Our judges can also nominate wildcard ETFs if they feel there's better choices elsewhere, or opt for split decisions. I've got the scorekeeping duties, and at the end of the program, we will declare an overall winner. Keep in mind, none of the battle outcomes that are on this program are ever predetermined or known in advance by our judges or myself. So let's kick things off with the first category. We've got Shana. Please get us started on cost.
So because we're dealing with two funds from the exact same fund family, their cost structures are identical. So both funds have 68 basis points expense ratios. So really what it comes down to in cost is how easy each is to trade. And given that SPYI has a longer track record, having been launched in 2022 versus QQQI, which just launched this year, hasn't even had a year worth of track record. There's a massive difference in their AUM. And SPYI is about 1.82 billion in AUM versus QQQI at 426.5 million, which means that there's greater liquidity and more shares outstanding for the older fund. And hence it has a better spread of 1 cent versus 4 cent. So on that small nuance, SPYI wins for me.
That's a strong start. Thank you, Shana. Mike, you're up next. How do you see it when it comes to cost?
There's literally nothing to add to what Shana put there. It's 68 basis points each. Triple QI has got a little wider spread than SPYI. Therefore, SPYI wins the category.
That takes us next to exposure strategy. Mike, you're up. So break it down for us.
Yeah, so I mean, you basically have two synthetic income strategies, derivative income strategies. One's tracking companies inside of the S&P 500. The other's tracking companies inside of the NASDAQ 100. So pretty straightforward stuff. There is a little nuance in their strategy relative to what you'd think of as the traditional covered calls. So potentially you might say that a better matchup would be triple QI versus QYLD, which is a global X strategy. That's a traditional covered call strategy, or SPYI versus YLD, which is, or not SYLD, YLD, which is a traditional covered call strategy. But neither here nor there. You have very different exposures of the underlying securities. For triple QI and SPYI, traditionally triple QI is the Nasdaq's more volatile than the S&P 500. Therefore, you're going to get a little bit more yield from that because you're writing these options. The income that you're generating is off the volatility of these options. So you're likely going to get a little bit more juice from trading from a yield perspective in that one. However, you're going to get more volatility from price performance perspective. So really, it comes down to what's more important to you. Are you trying to get as much return as possible and as much yield as possible? Therefore, you want to take on more risk with triple QI, or are you more about the yield and less about the participation in the market or the higher return, which I would suggest SPYI. So I can't really give an outright winner here for exposure strategy. I will tell you that the biggest thing about these strategies versus the broader market of synthetic income ETFs, which has seen a massive explosion in number of ETFs and AUM. There's almost $90 billion in synthetic income ETFs now, over 100 products. 5 years ago, it was 10 products and $5 billion. So huge amount of interest in these strategies. But I think what I would note is that this strategy in particular, within their option income, they're also throwing in some call options to try and keep up better with the index. Normally, a covered call or a synthetic income has a lot of tracking error. On the way up, it's not keeping up. On the way down, it does a little bit better because of the option premium. They're throwing in some call options to keep up. I'll get into it in performance, but anecdotally, they've done a little bit of that. They've outperformed the more traditional covered calls in an up market. So, the reverse is going to hold true in a down market. I don't have a winner. I could just play out the two different strategies because really it is a very different exposures in the NASDAQ versus the S&P 500.
Very good. And thank you for pointing out that we're analyzing mangoes versus bananas. And sometimes we get that on the show, what we call non-linear matchups. And not everything has to be linear. We don't live in a linear world, by the way, a world where all the choices are in the same category. So actually, I kind of like these non-linear matchups. Shana, you're up next. How do you see it when it comes to exposure strategy?
I fear this is going to be a battle where Mike and I, basically whoever went first, is going to get the bulk of the opportunity to provide value because we're not dealing with drastically different funds that have a lot of nuance from each other. I think we would even have more nuance, as Mike pointed out, if we were just looking at two NASDAQ covered call strategies that were by different issuers that versus the same issuer. So as Mike pointed out, these strategies' only difference is the underlying index of which they are mirroring. So one is doing the NASDAQ and one is doing the S&P. But the actual underlying strategy of how they're managed is identical. They're using a data-driven approach to their covered call strategy. They're using a tax loss harvesting strategy using Section 1256 to gain benefits on a tax basis. It's identical in both cases. So really, it comes down to, do you want to do this against the NASDAQ or the S&P? And everything Mike pointed out already is the same is what I was going to say. So I don't have much difference here. And again, I, like Mike, have no winner in the category because there's no differentiation other than the index. And that comes down to personal preference. So I consider this a tie as well.
That takes us next to performance. So Shana, you're still up. Give us your analysis.
So I'm going to point out two things here. In terms of performance, as Mike pointed out, because they have implemented an additional layer of call option purchasing and selling, this covered call idea, they are able to keep up with the market a little better than their peers. You can expect that you will not get 100% of the return of the index that they're replicating, but you will get pretty close. What you see with these two strategies is, within 100 basis points or less of the underlying index performance with substantially better distribution and yield. At the moment, because of everything that's going on in the market with the technology stocks, that is favoring the SPYI. But, this is totally point in time bias. I do want to take this moment to point out the income aspect of these strategies, because that is a component of total return. And that's, a component of measuring performance. And just point out something that I think is an important caveat to understand. So whenever you're looking at these high income strategies that are using this covered call or any sort of option strategy, you have a distribution rate and then you have an SEC yield. An SEC yield is a measurement of the yield of a security, right? And so the income that's produced with these strategies isn't income from a security per se in the traditional sense. So the way that they calculate SEC yield doesn't actually take into consideration, the income that you get from writing option contracts and selling them. It's not included. So you'll look at the SEC yield and you'll compare it to, say, a fixed income instrument or dividend yield, and you'll be like, well, this isn't all that compelling. SEC yield on QQQI is, I think, 0.3, and the one on SPYI is like 0.74. And so that doesn't seem that sexy. But that's why the distribution rate calculation is so important, because that's actually probably a better measure of what you can expect in terms of like the distribution from the fund. It's not perfect. It is whatever the last distribution that was paid for. Basically, if that was what was paid for the next 12 months, this would be the yield. And so because of the nature of these strategies, that's going to move. It's never going to be the same month to month, but it can give you a slightly better picture. And the distribution yield is more attractive for QQQI because, as Mike pointed out, option contracts and the potential income you can get from selling them tends to go up as volatility rises. And so you have better distribution yield with QQQI at a little over 15% versus SPYI at a little over 13%. And again, I can't pick a winner here because point in time bias says it should be SPYI, but I bet you if I went out to like 3 years, which I can't because QQQI doesn't even have a year's track record, but if I went 3 years, it would be QQQI because the NASDAQ's done better. So it's really a pick your poison situation. And again, I call it a tie.
Thank you, Shana, for that detailed analysis. Mike, you're up next. How do you see it on terms of performance and yield between these two ETFs?
So, yield goes to QQQI, performance goes to SPYI. But again, Shana pointed out, we're talking about a minute time frame here. These are both very new products. QQI, triple QI, that's what I told myself I was going to call it, is not even a year. So it's really hard to look at that. It's really going to come down to if S&P 500 is outperforming the NASDAQ 100, then SPYI is going to win, and vice versa if it's the other way around. So I think more from a performance perspective, when I looked at, because I'm intrigued by these products, I think it's a unique twist on a standard traditional covered call that they're trying to get a little bit more up market participation. So we do have 1 year of track record on SPYI, still a tiny amount of time frame, really from a true risk perspective. But if we take risk into that performance number, the SPYI relative to SPY, the S&P 500, has a up-down capture of 67% on the upside, 78% on the downside. And what I always tell people when looking at these strategies is your up and down capture similar, right? Are you, or at least, close to being similar, or best case, your down capture is better than your up capture. So your up capture is better than your down capture, then you're getting a better risk return. So not to get too complicated here, but right now it's upside down on that 1 year. Whereas if you were to look at the XYLD, which is a pure covered call strategy in the S&P 500, its up down capture is 47 up, 44 down on the 1 year. So it's staying in that positive territory and up down, but it's not keeping up as much because it has much lower numbers than what you're getting with SPYI. So it really comes down to that. Are you looking, what's more important to you? Is it are you looking for pure income and a little protection, which is generally what people are thinking when they think covered calls? Or are you trying to get income and as much participation as possible? If that's the case, I'm going to give the nod to these new NEO strategies. If it's more about protection and income, I'm giving the nod to the more traditional covered call structures like Global X has a couple that are XYLD and QYLD, which are pure covered call strategies. Sorry, I got a little into the weeds there, but I think it's really It comes down to preference of what is most important to you: upside participation plus income, or downside protection plus income. And that's how you should think about it when you're looking at these strategies.
Excellent. And are those your wild cards, by the way, those other ETFs?
They are, because they're directly related. They're both passive in the sense that the NEOS products are not passive, but the other two are purely passive, going against the S&P 500, against the NASDAQ. So for me, it was a good way to analyze these two strategies as I was prepping for this battle.
Yeah. Thank you for doing that and bringing those other ticker symbols into the conversation. Very well done. So that takes us next to the mystery battle category. This is where our judges can pick a certain factor or thing that they feel is crucial to today's contest. So, Mike, I'm going to ask you, what is your mystery battle category and which of these ETFs wins it?
So I buried the lead like I always do. Risk return is everything on when you're looking at these strategies for me, and that's what you should be thinking about. The way I look at all these strategies is looking at up-down captures. I like to look at up-down capture, at least a 3-year track record, so it's very difficult with these two strategies, but I think that's what you're looking at, right? Do you have a positive higher up capture than you do down capture? That's ideal. You're not always going to get that, but are you staying close to it? And then what is that up-down capture ratio? Meaning, is it 50% of your underlying, your true benchmark? Like in this case, SPYI would be against the S&P 500. Where is that ratio? And then that helps you decide how much protection I'm going to get, how much participation I'm going to get, and vice versa there. And then you can really kind of weigh that. And I think a lot of times people need to be careful, using benchmarking relative to the S&P 500 is great, but how you're putting it inside of your overall portfolio, it might be thought of more of as an alt type concept, not truly as an equity allocation. So that's my mystery. And I'm going to shut up and turn it over to Shana.
And I saw her perk up when you mentioned alts. So when you mentioned alts, the queen of alts, Shana, you're up next. What is your mystery battle category and which of these ETFs wins it?
Yeah, I got really excited when he started talking my language. My love language is alternatives. Everything Mike said is true. I actually have always viewed covered call strategies as alternatives. And the way that I incorporate them into portfolios is thinking about just downside protection while maintaining some level of equity beta, because I want to protect a portfolio from an unexpected downturn, but I want upside participation because my most likely base case scenario is that the market's going up. And so that's the role they play. And for me, when I use them, I'm going to go a little bit in a different direction. This has been a hard battle because every category is kind of like neutral in terms of the winning fund because they're the same basic fund. But I do want to point out that tax advantage of this particular product. So we've spent a lot of time talking about up-down capture and how this is against traditional funds that are doing traditional covered call strategies. But I think it becomes more nuanced when you start to look at how these products perform on a tax-adjusted basis. All of a sudden, the advantage of the traditional doesn't look as much of a win. They look more similar. And so these strategies are using particular index options that qualify for preferential tax treatment under the tax code. And so that, to me, is an advantage that you don't get in traditional covered calls that I wanted to point out. But they both do it, so it's not like I can say, well, this is the differentiator. And so for me, it's a tie. Both of them do it. But I did want to point that out because I think it's a valuable way to add and taxable accounts to use these strategies.
Point well taken. Thank you, Shana. Now we've arrived to the part of the show where our judges can give us their overall winner. So how will this shake down? Shana, give it to us.
It was really hard for me to, there's no winner in this battle. It's tie. Let's just start there with the headline. I know Mike has wild cards. I don't do a lot of investing in this space. I actually used to run a covered call strategy for a firm I used to work with, so I'm very familiar with them. But I've never used the funds per se. And the only product that I really love in this space isn't an ETF, so it's completely irrelevant for this battle, but I'll throw them a shout out, which is the OG of covered call strategies, which is the one that is managed by the Gateway. I like that fund for a lot of reasons, but my favorite reason is if you read Harry Markopoulos's letter to the SEC about Madoff from 2007, he actually does a comparative analysis of Madoff's strategy versus the Gateway strategy, because Madoff said he was doing covered calls. And so it's kind of like this fun little pop culture reference that you can look back on as it relates to the Gateway fund. That is the fund that whenever I was doing covered call, I would use, but it's a mutual fund. It's not an ETF, so it doesn't really qualify to be a wild card. So I don't have a winner of the battle. They're both good funds. It's pick your poison. Do you want NASDAQ or S&P? And, as far as I'm concerned, I don't do a lot of covered calls unless I'm actually managing the portfolio. And if I was, it wouldn't be using any of the ETFs. I'd be using the Gateway product.
Thank you, Shana, and dropping some Wall Street history. Wow, that was pretty awesome. Thank you for doing that. Mike, your final chance to weigh in with your overall winner.
Yeah, I didn't know that nugget. Nice job, Shana. I'm gonna have to go check that out. Well played. So it's a draw for me as well. I mean, from a standpoint of, what you're looking at for versus these two products, I can't name a winner because they're the exact same strategy on two different indexes. And that comes down to preference on which index do you want to track? What are your macro assumptions on that index? All kinds of other things. I would point out that just kind of repeating what I've already said, which is, understanding the covered call space and how to look at it. I think Shana did some great jobs talking about taxes. That's definitely something to understand for all these strategies, whether it's the ELNs like JEPI uses, which is the largest in the space, or whether it's pure covered calls or more of an active option overlay approach like these NEOS funds. It's a great thing to consider within that. But at the end of the day, to quote probably one of my favorite movies, take the draw, we'll share the championship.
All right.
Can you name the movie?
I don't know.
The draw, we'll share the championship.
Was that The Sting?
No, it's Searching for Bobby Fischer.
Okay.
When the little kid
I
at the end.
definitely wouldn't have known that reference.
Yeah. So now we're getting movie trivia on ETF Battles in addition to
I had to try to keep up.
Excellent. Well, our judges have spoken, and according to my battle scorecard, this is a split decision between SPYI and QQQI. We also did have some wild card ETF choices mentioned by Mike, and our judges brought it big time. And really, it's a matter of what are you looking for? Which index do you want to have exposure to, number one, but also that premium that you're getting from the call options. Obviously, it's going to be higher with the triple Qs just because it's a more volatile index, and you're going to get higher premiums because of that. So if you're looking for more yield, then that may be the better choice. So it's really, when you think about it in culinary terms, today's battle was like huevos ranchero versus enchiladas. And if you're my wife, you like neither. You prefer, well, she likes both, but she prefers chilaquiles. And I'm not going to argue with her. But again, well done. Thank you both to Shana and Mike for your outstanding analysis. We couldn't have done it without you.
Thank you so much.
Awesome. Thanks, Ron.
Well, be sure to visit the description section below. Get in touch with our judges as well as our program sponsor, Direction. Big thanks to Eric LV777 for this episode's ETF battle suggestion. Well done. And the question for the rest of our audience, which ETF matchup would you like to see on our next episode? Send me your ticker symbols in the comment section below or on our X feed at ETF Guide. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you on the next episode.